Okay, good afternoon. So today I want to introduce you to taxation. So I think last time I did make just a demo on capital allowances. I think as we progress, I'll make a comprehensive lecture on capital allowances. So we'll look at the implements, plant and property. And then we're also going to look at industrial buildings. We'll look at commercial buildings and capital allowances in the mining sector as well. So those are some of the things that we're going to discuss in the progressive lectures that are coming. But today I thought I'd do an introduction to the Zambian tax system. So this is just a lecture that will help us understand what taxation is in Zambia, the history of taxation, and all those things. So just allow me to share my screen with you so that we can dive into the lecture. All right. Interesting. Okay. Right. Okay, so let's look at taxation. So my name is Kelvin Kapotwe. I will run you through the introduction to the taxation system. So I come representing Virtuous Tax Corporate Services, which is a firm that is into coaching, training in business and accounting. So I usually do taxation as well as financial reporting. So those are the courses that I can dive in and help you understand. The other things that I'm going to do is that I'm working on a very short course. I'm calling it a master class in finance. So basically that one is just for non-finance professionals to just come and appreciate the meaning and learn how to interpret the financial statements, learn about the financial statements, and then how then do we interpret the financial statements? What stories lie behind the numbers is what I'll be talking about in the lecture that will come through. Hopefully that you will be able to come and support this course. I will charge a very, very, very small fee for that lecture. And it will be comprehensive in such a way that I'll be talking about the things that I do on a daily basis, looking at financial statements and finding the stories behind the numbers. All right, so that said, now let's dive into our lecture this afternoon. All right, so I believe we are able to see the screen there. So today is Introduction to Zambian Tax System. My name is Kelvin, as I said. So what are the objectives for this lecture? So the objectives is that we need to understand the Zambian system of taxation. And then we're also going to look at the functions of taxation in the economy. What are the functions of tax? What does tax play in the economy? Then we'll look at the qualities of a good taxation system. So just like any other system, just like anything else, a good taxation system should have certain qualities. All right, so we're going to look at the qualities of a good taxation system. And then finally, we are going to look at the classification of taxes. All right, so we'll look at the classes of taxes. All right, so when you look at the Zambian system of taxation, so first thing first, we need to understand what taxation is. All right, so what is taxation? So taxation is basically the process of raising revenue for the central government through levies on income and gains of resident persons. Okay, so taxation is a process, all right? It's a system of collecting or raising revenue for the central government. But this revenue is raised through the citizenry, okay? So citizenry or citizens do get income, all right, at different levels. So the state do levy what is called a tax on the income, on the gains that every citizen earns in an economy or in a particular jurisdiction. So that is what taxation is. So when you talk about taxation, it's basically a system, it's basically a process, all right? So there's a difference between taxation and a tax. So taxation is the process or the system of collecting taxes from the citizens. So that is the definition of taxation. Then tax, what is a tax? All right. So a tax is a compulsory contribution levied on the income and gains of resident persons of a particular country. Resident persons may pay a proportion of their income or gain to the state, all right? So that proportion of income that a resident person do pay to the state is what is referred to as a tax, all right? So if you've observed in my two definitions of the taxation system, what is taxation and then what is tax, there's a common word that is coming there, which is resident. I think we are going to dive into those details as we progress in the lecture, but just to preempt something, a resident person is someone who's currently present in Zambia for not less than 183 days in a particular charge year. So if you are present in the Republic of Zambia, whether a natural person or persons other than individuals, which are companies, if you are present in the country for a period not less than 183 days in Zambia, you are a resident citizen. So you are a resident and you're liable to pay tax to the state. The other definition of a resident is you and me who are born in the Republic of Zambia. So individuals that are born in the Republic of Zambia are resident to Zambia, and as such, we are liable to pay taxes to the state, all right? The thing is companies that are registered in the Republic of Zambia, those that are controlled in the Republic of Zambia, where the central management is in the Republic of Zambia, those companies are resident companies, and as such, they must remit a tax to ZRA. Okay, so that's what that resident persons mean. So now let's try to look at the taxation system or the history of taxation. So we are told that citizens had to provide for themselves everything they needed in order to survive. As such, a lot of confusion came about, okay? So imagine a situation where you want hospitals to be built, all right? And then we've got different people. So if they say, okay, at this hospital, we are going to put it in Buchi, all right? Then another person says, no, we can't put it in Buchi. That's too far. We are going to put it in Ndeke. Another one will come and say, no, this hospital has to be put where the vulnerable are. So there's just that confusion. So now what would happen is, imagine it's a situation where those that have got the resources, for example, will make the decision and decide maybe to put the hospital in Riverside, okay? So there was too much confusion and there was no equity. And then during the wars in Europe, during the wars in Europe, there was a system that was used by the state to raise revenue to, to sponsor or to fund the military in those days as they were fighting. So that system actually really worked very well in such that after the wars had finished, the government then thought, okay, you know what, this system is very good and it worked. And the system was that they were collecting a percentage from the citizens to help finance or to help fund the wars. Okay, so this system did really work. So they said, okay, you know what, I think it's a system that we can apply to help us rebuild the cities. Okay, so after the war, the cities were destroyed. So they said this is a system that we can use to help us rebuild the cities. So we are going to continue by collecting a percentage of people's income, okay? And that is that is the beginning of taxation. And that's how tax started. I mean, it was very bad. It was very bad in such a way that this system really worked so well. People were contributing. People were eager to make sure that they've got nice cities. People were eager to make sure that their countries are rebuilt. So these taxes went as high as 90%. And because of that, now people started shunning away from that. And then that's where now we've seen serious developments trying to improve and make sure that the tax system is equitable, make sure that the tax system is efficient. So that is a brief history of the taxation system. So the taxation system that we use in Zambia, Zambia being a colony of the UK, Britain. Zambia being a colony of Britain, the British taxation system actually was adopted as the taxation system that is applicable currently in Zambia. So we've got common laws. We've got common laws with regards to taxation with Britain as well as ourselves. A few changes may be there. A few changes have been made over the years, but principally the taxation system was adopted by our colon masters through Zambia called then Northern Rhodesia. So that is all about the Zambian taxation system. This is the history of the Zambian taxation system. We can now proceed to look at the functions of taxation in the economy. What are the functions of taxation in the economy currently? Okay, what does taxation do in an economy? So learn this, and this is very important. We need to understand what tax is. Even when we contribute to the state, we need to be knowledgeable. That's why we find time to devote an hour or so just to share this knowledge. When we say taxpayers' money is at waste, you should understand what is the taxpayers' money supposed to do? Okay, where is it supposed to be allocated? So that even when you say, okay, there is misappropriation of taxpayers' money here, we can all fight that in a knowledgeable way and with proper understanding. All right, so the functions of taxation in the economy. So the first one is revenue generation for the central government, okay? So as we said in the definition, the functions of tax in an economy basically is to generate revenue for the central government. So the revenue that is generated for the central government is then used, okay, is then used by the state to meet public expenditure. Remember when I started, I was given an example of the confusion that would be there if every individual was asked or was tasked to contribute to the economy, or if for example we say, okay, citizens should do things on their own. Imagine, do you think there will be that order? So what happens is the central government has appointed a board or the authority that is in charge of collecting that revenue. So that revenue is collected by the Zambia Revenue Authority here in Zambia called ZRA. So ZRA was enacted by an act of parliament. It was instituted by parliament, and they are mandated to collect revenue on behalf of the Republic of Zambia. All right. So that revenue that is collected is then used to fund public expenditure. So public expenditure relates to education, For example, the health sector, road network and other infrastructure in the economy or in the country. Then it is also used for defense purposes, etc. So these are public expenditures. We've got social cash transfer. We've got different public expenditures that the government does engage in. So this is the revenue that is used to fund these expenditures. So that is the first and most important function of taxation in an economy. Hopefully, I've explained this point clearly and you've understood. All right, the second one is influencing economic activities in the country. So taxation does influence the economic activities in the country. Tax is used as a stimulant to economic activities in an economy. So the state offers tax incentive for citizens to engage in activities that contribute to the economic growth. For example, capital allowances, lower rates on interest income, for example. All right. So how does this stimulate economic growth? All right. So imagine in an economy, there are people that engage in trade. In an economy, there are people that engage in production. So the more we produce in an economy, the more we engage in economic activities, for example, trading, we engage in businesses. That's how the economy grows. So when you talk about economic growth, you're basically talking about the production growth in that particular country. The economic activities happening in that particular economy. Those things drive economic growth. So now, how does the government make sure that they encourage individuals or persons that are engaged in these activities? So they do offer what is called tax incentives. An example of this is the capital allowances that are given on implements, plant, and machinery, for example. The capital allowances that are given on industrial buildings and the capital allowances given on commercial buildings, etc. For example, in the manufacturing sector, all right? So in the manufacturing sector, if you buy a machinery, you buy an implement that is used for manufacturing, ZRI or the state has given you a 50% discount. So they are going to give you a capital allowance of 50%. What that means then is you can offset that off the profits, the business profits. So if you are, for example, going to pay, I'll give an example just for argument's sake. If, for example, the tax that's supposed to remit to ZRI is say 200,000, and you bought a machinery that was costing say 100,000, ZRA will give you a capital allowance of 50%. So meaning 50,000 you claim against your profit, meaning you're going to pay your taxes less of capital allowances. So that is an encouragement and helping to stimulate economic growth. So in the agriculture sector also, we see government as almost given 100%, as actually given 100% on most of the implements that farmers do use. Okay, so they have actually given those incentives. So okay, farmers can claim capital allowances, say at 100% on property, plant, on implements and machineries. So those are some of the things that are used to stimulate economic growth. Sometimes companies are given tax holidays for them to set up industries in the country and create employment and all those things. So incentives are given just to drive economic activities in the country. So that is the second function of taxation in an economy. I hope I'm audible. I hope I'm clear enough and able to get what these things mean. The second one is redistribution of income and wealth. Very important. And now I want to talk about this and listen very carefully. Redistribution of income and wealth. Some individuals earn more than others. As such, those who earn more get richer and those earning less get poorer. To address this, I think this is a principle that we all know. The richer gets richer and the poor gets poorer. So now to address this, government uses the progressive tax system as a wealth distribution mechanism, all right? So a progressive tax is a wealth distribution mechanism that the government is going to use to make sure that wealth in an economy, income in an economy is equally distributed. Let's take this example. Imagine there was no taxation, and then the government says, okay, do as you please. There will be no hospital in Bush. There will be no hospital in Musonda, Mulenga. In Musonda, there where my brother stays. There will be no hospital in there will be no hospital in Makululu in Kabwe. There will be no hospital in Buacha. Because I mean, if the rich are going to make sure that they put the hospitals in places where they stay, for example, and they are going to make sure that they've got the top-notch hospitals in those areas, and as a result, you find that those that are staying in shanty compounds, those that are less privileged, those that are low-income earners, will not afford to go to these hospitals because, number one, they'll be expensive, they'll be classified as classy and all those things. So now, to keep all these things down, the government says, okay, you know what, we are going to use a system of taxation to try and address this issue. Apologies for that. There was a call coming from. All right, so they're going to address that issue. So this is how the government uses taxation. So now what happens is when this revenue is collected, a budget is made on how the government is going to spend money in each constituency, in each province, in each district, and then they are going to allocate to different ministries, they are going to allocate to different cost centers. So that is how taxation helps the government to redistribute income, such that we are going to have Quito Central Hospital here in Parklands, a good hospital. We are going to have a military hospital. We are going to have Ndola, top-notch, hospitals that everyone can go to, and whether you are a low-income earner, you are a high-income earner, you can actually go to those hospitals and you get the treatment. You can go to whatever school and you can get the education that you get. This is how come we have a president who's coming from a village and today is a president, okay? He's coming from Wengwa. You have me seated here sharing this knowledge. I'm actually coming from a typical village, from not a well-to-do family, from a low earning income. My father was a class teacher. But here I am today. I'm in the city, and I'm able to share in the country's cake equally as well. This is because of taxation, because income was collected from the citizens and it was redistributed equally. Nice schools were made. I went to St. Clement's Secondary School, later on went to Mansa High School. I went to Zip. I did Zika, and then I've also gone to the University of Zambia, and I did a bachelor's in accounting and finance. And here I am today. I'm working with one of the organizations. So that's how income is redistributed. The other one is maintaining the well-being of the environment. So taxation is also used to maintain the well-being of the environment. In some jurisdictions, heavy taxes are levied on activities that are not so friendly to the environment. For example, activities contributing to global warming are discouraged using taxes on income or assets used in the conduct of those activities. So for example, you and me do import cars from Japan. Do you know that for certain types of vehicles that are imported in Zambia, there is a tax called carbon tax charged? Okay, so that is a tax that is charged for that carbon emission that the cars do, those second-hand cars, produce. So carbon does affect the ozone layer. Carbon does affect global warming. So government is going to use a tax to try and discourage those things. All right, you'll find that, for example, if a company is engaged in activities that affect Today we are talking about climate change, the effects that we are seeing in the seasons. Right now, we are talking about El Nino and all those things. This is because of the effects of activities that we engage in as citizens that are affecting these things. For example, charcoal and all those things. There are chemicals that are emitted in the hemisphere and all those stuff. So these things are actually contributing to what we are calling climate change. Today, the climate has changed, and now we see governments coming on board trying to make sure that actually all institutions are coming on board trying to make sure that we try and restore some of these things, because the consequences are quite severe. And actually it threats food security as well. So we see people encouraging green energy and on all those stuff. And actually the government is also giving incentives on such things that are speaking to climate change in terms of taxation. So you equally have to import those things at a lesser cost at the border, just to encourage this aspect. But to discourage these things, colleagues, the government does apply certain taxes which are quite huge so that we can discourage this. All right. Now let's look at the main taxes found in Zambia. What are the main taxes found in Zambia? So the main taxes that we have in Zambia is income tax, okay? So income tax is levied on aggregated income and gains of resident persons. I talked about the residence of a person, so I'm sure at this particular time, when I talk about resident persons, all right? So income tax is a tax levied on aggregate income and gains of resident persons. So by aggregate income, I'm talking about all the incomes or the gains that an individual makes. They are summed up together and subjected to what is called the income tax system. All right, so income from different sources grouped together, and then this is taxed. So that's what we mean by aggregated. So aggregate income is taxed or levied on resident persons. So that is income tax. All right, so in Zambia, income tax is only applicable to those companies that in the case of companies. So this is only applicable to incomes that are earning 800,000 kwacha per annum and above. So if your turnover is 800,000 kwacha per annum and above, then you qualify for the income tax system to be applicable. Those that are lower than that, they fall under turnover tax. All right. And then we have what is called mineral royalty tax. Mineral royalty tax. So this is a tax received as a consideration for the extraction of minerals. So for those companies that are engaged in mineral business, so in extraction of minerals, copper, cobalt, talk about gold, those that are in mining do pay what is called mineral royalty tax. So the mineral royalty tax is a consideration for the extraction of minerals. This tax is remitted to the state. Then the other tax that we have in Zambia is value-added tax, all right? So the goods, there are certain goods that, so I'll give an example. A good is, let's do this. Wheat is planted. I'm in agriculture. I'm not an agriculturist, but I deal with farmers. So let's use this example. So wheat is planted in the soil. A farmer waters it and they harvest. That wheat is then sold to a company called maybe a commodity dealer and others. Or maybe let's just say that wheat is sold to G&G. Okay, so G&G then goes on and makes bread. So G&G has added value on the wheat that was sold by the farmer. So there's value that has been added to that particular crop. Now, that particular crop has now turned into what we call bread. We eat bread. So there's that value that has been added. On top of that, that bread is put in a plastic and then they seal it like that. So that is value that has been added. All right. So value added. So for the value that has been added, a consumer has to pay what is called a tax. All right. But these goods are different. So they are goods, there are goods that are taxable and goods that are not taxable. So we call them taxable supplies, and then non-taxable supplies, or zero-rated supplies, or standard-rated supplies. So those that are standard-rated, VAT is charged at a rate of 16% in Zambia. Those that are zero-rated, they are taxable, except they are taxed at zero, okay? And then those that are exempt, they are not taxed, so no VAT is paid on them. So value-added tax is an example of, is one of the taxes that we have in Zambia. Because of the value that has been added to a product, a consumer has to pay. So value-added tax is the only tax which is not levied on income, but it is levied on expenditure. So when I go to buy something in ShopRite, I pay what is called a tax, 16% of those goods. The standard rated goods, for example. Those that are standard rated, I'm going to pay 16% for consumpting those goods. So that is value added tax. Then the other type of tax is custom and excise duties. So for you and me who have imported goods before from other countries coming into Zambia, we are subjected to pay what is called customs and excise duties. All right. Sometimes you also pay VAT, import VAT. All right. So custom and excise duty is charged on the value of duty for purposes of imported goods and certain goods being exported. So excise duty is charged on some imported goods and some locally produced goods and services. So that is another type that we have. Then the other one is a property transfer tax, all right? A property transfer tax all right, sorry. I just wanted to make sure I'm recording. So a property transfer tax is charged on the realized value of a property that is transferred from one person to another. Note this, property transfer tax does not apply to movable assets like motor vehicles. So property transfer tax is not paid on motor vehicles. By property transfer tax, we mean you sell shares from one company to the other, or from one person to the other. That is a property. You're going to pay property transfer tax on those shares. For example, if you sell a house, that is a capital good. You sell it to another person. You've transferred a property from one individual to the other, okay? So on the realized value of that particular property, you're going to pay what is called property transfer tax. So PPT is going to be paid on that, all right? Hope that is clear. Then the other type is what is called a turnover tax. So I mentioned turnover tax when I spoke to income tax earlier on. So turnover tax is a tax that is levied on the turnover or the revenue of a business, okay? In Zambia, currently, turnover tax is at 4%. Any business that is whose turnover does not exceed 800,000 kwacha in a particular charge year is subject to pay turnover tax. However, you can elect to register for income tax, all right? You can elect to register for income tax even if your turnover is actually 800,000 or below 800,000. But however, income tax is tedious because if you're a small company and you don't have the needed resources to, administer income tax, it's quite tedious because it requires you to do what we call provisional taxes. So you need to do provision taxes 4 times in a year. So you need to make sure that you pay the government provision taxes every quarter. So every quarter you're actually supposed to be making sure that you determine, so you project what your revenue is going to be, so you budgeted profit, and then from there you do your adjustment for income tax purposes, and then you pay a tax. If the tax that you pay ZRA at the end of the year exceeds what you have actually made in a particular year, then you're not going to pay ZRA. So what that means is ZRA is owing you, and that is what you call in financials called tax credit. So when there's a tax credit, meaning ZRA is owing you money and you're going to receive that money from the government. So they are going to actually refund you. You can offset it against other income. Though I think, if not mistaken, offsetting is I think it's mostly what usually happens. Yeah. But if the projected income is actually lower than what you have declared and what you've paid ZRA, then at the end of the financial year, I think it should be June 21st, you need to make the actual return now and submit to ZRA. So those are the main taxes found in Zambia. I hope you understand and you've absorbed the information that has been shared with you. All right, so now let's now look at the last part, which is the qualities of, no, sorry, not the last part, almost there anyway. I think should be the third last slide, qualities of a good taxation system. So every system should have qualities, all right? So if a tax system is said to be good, what is it that makes it good? All right, so now let's look at the qualities of a taxation system. The qualities are sometimes called the canons of taxation. All right, so the canons of taxation were coined by an old economist, or a British economist called Adam Smith, who lived between 1723 and 1990. So this economist is actually the one that coined the taxation system. All right, so Adam Smith was the first to introduce the canon of taxations. So these are still relevant to modern taxation systems. So despite them being coined in a period between 1723 and 1990, in that range, these canon of taxation systems are still applicable and very relevant to today's taxation systems. Any taxation systems that does not embrace these qualities is actually a bad one and actually bound to fail. All right. So the canon the canons of taxations are the principles that underpin effective and just tax system throughout the world. Number one, a tax must bear as lightly as possible on production. Very important. Bear as lightly as possible in production. So taxes should not be so high such that they make production expensive. Heavy production taxes make production expensive, and as a result, businesses are bound to fail and there will be no economic growth. All right. So if your taxes are high in an economy, businesses will be working for the state and they won't be making any profit. And if they're not making any profits, there will be no production in a particular economy. The economic activities actually goes down. And when the economic activities reduces, what you are saying is you are killing the economy. These businesses will exit and go to other jurisdictions where the tax systems are actually convenient. So every taxation system should bear as lightly as possible on production. I hope that is clear. Number two, easy and cheap to collect. So taxes should be cheap and easy to collect and must fall directly on the ultimate payer. If collections of taxes is tedious and expensive, resources are wasted if amounts collected are low. So if taxes are expensive, if taxes are expensive to collect, little resources are going to be collected. If a tax is not easy, okay? If a tax is not easy, if a tax system is not easy and it makes revenue, it makes ZRA not to struggle in the collection of taxes, you find that they are going to be spending more money trying, for example, to go in far-fetched areas, okay, to go and collect these revenues. So that's why the government came up with ZRA, more of a body that has got people with different expertise and skills who can sit down and try to deliberate on how best they can collect the revenues for the government, on how effective and how cheaply can this revenue be collected. Because if we spend more money to collect less taxes, then we've not done anything. So that is one of the good, or the qualities of a good taxation system: easy and cheap to collect, period. Don't go in the explanations I've given. When this comes, just say a tax system must be easy and cheap to collect. If you want, you can put your own English and make sure that you know what you're talking about. Value-added tax is an example of a tax that is not borne by an income, by a taxpayer. Okay, so there's a point there which says, and must fall direct on the ultimate payer. Taxes must pay directly on the ultimate payer. Now, with value-added tax, the difference is this. Value-added tax, the tax does not fall directly on the taxpayer. This is how VAT works. So, I'm the one buying the goods. I'm the taxpayer. But the person that is charged with the responsibility to remit those taxes is actually the trader, a registered trader. So that makes taxation, that makes VAT a tedious tax, okay? It makes it a tedious tax because the taxpayer does not have that responsibility to remit to ZRA. But this responsibility has been shifted on to another person who must collect. When they collect, then they have to remit to ZRA. And then when you look at the VAT system, there's what we call input and output VAT. So you'll find that if a trader is a registered trader and they are dealing with other registered traders, there's actually what they are supposed to, there's something that they claim from ZRA, okay? So they collect and pay ZRA. But also when they bought, when they bought from their suppliers who are also registered VAT suppliers, they actually paid VAT to them. Okay, so now they need to recover the money that they paid to their registered suppliers. So that's how come, that's why VAT is actually a complicated tax type. But all the same, I think it's been working for some time now in Zambia. Then the other one is certainty. So tax rules must not be complex because they can be subverted and evaded. So if tax laws can only be understood by tax specialists, then only those taxpayers with the capacity to engage tax specialists who comply with the rules or the laws, hence the need to be easy. So a tax system should be certain and it should be easy to understand by every citizen, all right? So I should be able to understand how much I'm going to pay ZRA. I should be able to understand why I'm paying ZRA so that I don't evade taxes. Tax evasion is a crime. Tax avoidance is allowed. So you can actually avoid taxes, but you cannot evade taxes. So evading tax is a criminal offense, but avoiding tax is allowable under the Income Tax Act. So if you know what to do, if you want to know what to do on, or if you want to know what you must do for your taxes to be allowed, engage a tax specialist and pay them money so that they can help you understand those things. But I think for those that I'll be taking in taxation, I'm going to explain to them how taxes are avoided and the laws that actually prescribe the avoidance of taxation. But for evasion of taxations, colleague, it's a criminal offense to engage in such, and just make sure that you avoid taxations, you avoid tax legally. All right. The last one should be equality. Taxes should bear equally to give individuals an advantage, should be levied on the ability to pay. If this principle is not applied, then those individuals in low-earning groups will see taxation as a burden, and that those earning higher who actually, than those earning higher. So imagine a situation where you make 5,000 kwacha, and then there's one who's making 50,000 kwacha. But they say, okay, everyone must pay 1,000 kwacha as a tax to the government. Is that fair to you as a taxpayer? Remember, there's one who's earning 5,000 and the one that is earning 50,000. All right, so if the one that is earning 50,000 is taught to only pay 1,000, is going to remain with 49,000, for example. At this particular time, I've not taken into account pay as you earn. Yeah, I've not taken pay as you earn into account. So I'm just talking about I'm just giving a literal example. So that one who was a 5,000 will actually remain with 4,000. Little money. So now, a good taxation system should be equal. That's why you find that apologies, I think we had a setback. Network issues, all right. Okay. Okay, sorry for that. A bit of technical issues there. All right, so quickly, let's wrap up. So equality, I've talked about the equality. So what this means is the standard rate should be used to tax certain individuals so that at least a proportion of someone's income is paid in terms of taxation. Now, so we were talking about the canons to taxation that were coined by Adam Smith, but the modern economists have also come to add their understanding. They have come to add their thoughts as well. So in addition to the original canons developed by Adam Smith, modern economists have developed the following. So number one, taxes must not hinder efficiency. Where it is not possible to achieve efficiency, the tax should involve at least Sorry. A tax should involve the least loss of efficiency. So a least efficiency should be is actually acceptable. So least efficiency is acceptable, but taxes should not hinder out maximum efficiency or optimum efficiency. A tax system must be compatible with other foreign tax systems. For example, the Zambian tax system must be compatible to the tax systems of the SADC and COMESA member state tax systems. All right. And then the other one is taxes must automatically adjust to change in the rate of inflation. As inflation rises or falls, tax system should automatically adjust accordingly. Let's look at the last slide as we conclude our lecture. All right. So classification of taxes. What are the classes of taxes? So number one, direct taxes. So direct taxes, these are taxes that are directly levied on the income and gains, normally as a percentage of income or gain. Example of direct taxes is income tax. Okay, so income tax is a direct tax on income. Property transfer tax is also a direct tax. So generally, direct taxes are progressive in nature, okay? The amount of tax paid is dependent on the level of income. So the higher the income, the higher the tax paid, meaning people with low income will not pay the same amount of tax as those who earn more. All right. Then we have got another class called indirect taxes. So indirect taxes, so this is the tax that are imposed indirectly. They are borne on expenditure and are therefore borne by the consumer. So number one, these taxes are borne on expenditure and they are also borne by the consumer. Traders who are registered for this, for charging indirect taxes, charge these taxes on the supplies they make and collect taxes on behalf of ZRA. Okay, so the amount of indirect tax paid does not depend on one's level of income. So whether you earn more, you earn what, it is standard. You are going to pay 16% on the cost of the goods that you have purchased. Let's go to capital taxes. So another type is capital taxes. So these are taxes on capital receipts. So a capital receipt is income arising from the disposal of a capital item. For example, if you dispose of a property, which is a house, that property income that you are going to get is a capital receipt that you get. And as such, you are going to be charged they're going to be charged a tax called property transfer tax. All right, then we've got revenue taxes. So revenue taxes, these are taxes which are levied on revenue receipts. A revenue receipt is one arising from the sale of non-capital goods that were procured or acquired for resale. So if you own a grocery store and you make a sale, you're going to make revenue, and revenue taxes are then charged on that. Again, income tax is another type of revenue taxes, for example. So it's coming from that. Property turnover tax is also another example of revenue taxes. All right. Then we've got what we call a regressive tax. All right. Regressive tax. So these are taxes that represent a smaller proportion of a person's income. All right. It represents a smaller proportion of a person's income. As an income of that, as the income of that person rises, the average rate of tax falls. For example, VAT is a regressive tax that is a regressive tax. The VAT rate is the same on the good regardless of one's level of income. So whether you get 50,000 kwacha or you get 1,000 kwacha, you're going to pay a tax at the same rate of 16% when you buy goods from ShopRite, when you buy those standard rated goods. So VAT is an example of a regressive tax. Progressive taxes. So these are taxes which are levied on one's ability to pay. An example of progressive tax in Zambia is pay as you earn. So a pay as you earn, if you see, it starts from 0 to 37.5 now. Yeah, 37.5. Yeah. So Zambia, we are sitting at 37.5. So you find that those that are earning less than, so those are that are below 5,500, for example, will not be subject to paying tax. Their their income is taxed at 0. But the more you progress, for example, if you go up, your tax now is subjected to a rate of 20%. As you progress further, you find that you can actually hit the last band, which is 37.5. So those that earn more actually pay more taxes. That is called a progressive tax system. So the amount of tax that you pay is dependent on the income or the level of income that you earn. Then you've got what is called a proportional. We've got what we call proportional taxes. The taxes, so these are taxes that are proportional to one's income. A flat rate is applied regardless of one's level of income. So the turnover tax, for example, is somehow proportional. It's somehow proportional. Just give me a second. So it's proportional to the income that you make. So a percentage is actually applied on your revenue, so that it doesn't stress, or everyone should pay equally. Okay, so everyone should pay equally. That's why they use the term proportional. So if you make 5,000, 4% of 5,000 you pay. If you make 2,000, 4% of 2,000 you pay. All right, but I think there has been on turnover tax, there has been a 12,000 that has been allowed as tax-free. But I think as your income accumulates in a charge year, then you're subjected to pay a 4%. All right, so this I think brings us to the end of our lecture today, and more lectures will be coming through. I urge you to subscribe to my YouTube channel. So subscribe to my YouTube channel. I'll be sharing more insights on taxation, and then I'll also be sharing more insights in financial reporting, how those financial statements are prepared, and then what the interpretation. But I think I'm working on something that I'm going to post very soon. It would be at a fee of 250 kwacha per participant. So 250 kwacha, you make a payment, and then I'm going to have what I'm calling a masterclass in finance, where I'll be talking about, just for those that are non-finance professionals, if you want to understand the stories behind the numbers, what those numbers do tell, and what those numbers speak about. So those are some of the things that I'll be tackling there. So there, it's not, I'm not in the masterclass, I'm not going to teach you how to prepare those, because I spent 4 years on the desk to learn how to prepare financial statements. And I don't think I'm going to show you how to prepare financial statements in 3 hours. So what I want to show you is just to tell you how to read the financial statements when they are prepared, when they're presented to you, what each number means, and then what are the stories behind the numbers. So I'm going to share that. I think I'll post it. The advert, I think, will be posted. Let me just finalize on the material, and then I'm going to share on our Facebook page. We've got a Facebook page, Richard's Tax Corporate Services, and then there's also a page under my name, Kelvin Kapotwe. There also I'm going to share that advert, which we'll be looking at once I just conclude, and then we can have that masterclass together. It will be an opportunity for you to ask questions. My financial analysis and interpretation of financials is something that I do on a daily basis. I think it's within the scope of work that I do. So I think I'm also going to apply some practicality to it as well. I've had the chance to work with different brilliant minds who've actually contributed to my growth in how to read financials, despite what I learned in school. But I think I've worked with different, brilliant minds in finance, and I think that knowledge, I think I would also love to share it with you, because I think sharing knowledge is just at the bottom of my heart. Thank you so much, and may you have a very good day, and see you next time. Thank you so much.